Now that we know that the meaning of the word option is choice, let us try and understand the concept of trading options. Let us consider a car standing in a showroom. And let us say today is 1st of June 2021 and the price of the car today is $100,000. It could be dollars, rupees, reals, yen, whatever. The currency does not matter. Please try and understand the concept, and the concept will remain same across the globe. So we are considering a car standing in the showroom and somebody wants to have the choice of buying this car. Mark my words, I am not saying that somebody wants to buy the car. What I am saying is somebody wants to have the choice of buying the car. Alright? That means the option of buying the car. So there has to be a buyer of the option and there has to be a seller of the option. Alright? Now the buyer of the option or the buyer of the choice says that I want to have the choice of buying this car at $100,000 on or before 30th of June 2021. In effect, what he is trying to say is that I want to buy this car at today's price but at a later date. And why is he saying so? Because he believes that the price of the car will increase in the days to come and therefore he wants to lock the purchase at today's price. Alright? And the seller of the option or the seller of the choice says, okay, I grant your choice. You can have this car at $100,000 by 30th of June. But in return, you will have to pay me a non-refundable premium of $2,000. Because I am giving you the choice, you will have to give me a premium. Alright, and I'll lock the value for you. Why is he saying so? Because he believes that the price of the car will not increase, but it will reduce. So these two people are having opposite views. Alright. And since the choice being traded is about buying, we know that the choice of buying or not buying is called a call option. Alright. So therefore, this person, the buyer of the choice, is said to have bought a call option by paying a premium of $2,000, and the seller of the choice or the seller of this option is said to have sold a call option by receiving a premium of $2,000. Now please remember, what is being traded is not the car but the choice of buying or not buying the car. Alright. Now let us say 30th of June has arrived and the car is still standing there in the showroom. Alright. Let us see what the buyer of the choice and the seller of the choice have to say. Let us say that on 30th June, the price of the car has not increased, but it has come down from $100,000 to $80,000. Alright. Now, under these circumstances, do you think the buyer of the choice or the buyer of the option will pay $100,000 to buy the car when he or she knows that the car is now available in the market for $80,000? The person who has bought the choice has got the choice to buy or not to buy. So do you think he will buy it at $100,000? Certainly not. He will say that, sorry, I don't want to buy. So what happens is, the seller who had sold the choice or sold the call option retains that non-refundable $2,000, which is the profit for the seller of the choice. And the buyer of the choice has foregone this $2,000, so he is losing $2,000. Got the point? But suppose the price of the car has increased from $100,000 to $120,000. All right, consider another scenario. The price has not come down, it has increased from $100,000 to $120,000 as was expected by the buyer of the choice. Now, do you think under these circumstances the buyer of the choice will pay $100,000 to buy a car which is now worth $120,000? Certainly, he will run to the seller of the choice and tell him, look, here is the $100,000, please take this, and now you are bound to give me that car at $100,000, though it is now costing $120,000. All right. So what does it mean is the seller of the option is losing $20,000, the difference between the market price and the price at which the deal was struck. All right. They will not be physically exchanging the car because we are talking of derivatives. We are talking of derivatives, and therefore there is no physical settlement. The settlement is only in cash. All right. So the difference of the price they will exchange now. The option seller has to give $20,000 to the buyer of the option. And since he had already taken $2,000 as a non-refundable premium, so his net loss is $18,000. And for the buyer of the option, the net profit is $18,000 because though he is taking $20,000 now, $2,000 he has paid earlier as the non-refundable premium. All right. So what it boils down to is that the buyer of the call option has a limited loss. Had there been a loss, the loss would have been limited to $2,000, the amount of premium which the buyer of the choice had paid. But if there is a profit, then the possibility of profit is unlimited. The price of the car could have increased to anything, so the profit could have been unlimited. All right. And as far as the seller of the choice or the seller of the option is concerned, we are now talking of the call option. All right. So the seller has got a scope of unlimited loss, because if the price of the car increases to anything, then he has to shell out that money. So the loss could be unlimited. But the profit is limited only to the $2,000 premium which he has received. All right. I hope this concept of call option has been understood. Now let us consider another scenario. In the previous screen we had seen about the choice of buying the car. Now we will see the choice of selling the car. All right. A similar trade, but exactly a mirror image. All right. Again, let us consider that today is 1st of June. The price of the car is $100,000 standing in the showroom, and the price can change on a daily basis. All right. So there is a buyer of the choice and there is a seller of the choice. And now the buyer of the choice says that I want to have the choice of selling this car at $100,000 on or before 30th June 2021. Just recollect, in the previous case when we were talking of the call option, the buyer of the choice wanted to have the choice of buying the car. Now he wants to have the choice of selling the car at today's price. Why does he say so? Because now he believes that the price of the car will come down in the days to come. So he wants to lock the selling at today's price. Got the point? And the seller of the choice says, okay, I grant your choice, but in return you will have to pay me a non-refundable premium of $2,000 so that I will lock the price for you, the selling price, I will lock it for you. Why does he say so? Because this person now believes that the price of the car will increase. So if the price of the car increases, then this person will not come to sell it at a lower cost. All right. And now, since we are talking about selling, the choice of selling, therefore we know that the choice of selling or not selling is called as a put option, isn't it? And therefore the buyer of this choice or the buyer of the option is said to have bought a put option by paying a premium of $2,000, and the seller of the choice or the seller of the option is said to have sold a put option by receiving a premium of $2,000. Exactly a mirror image of what we have discussed earlier. All right. And again, remember that what is being traded, what is being bought or sold is not the car, but the choice of selling the car or not selling the car. Try and understand the difference. All right. Again, let us say that 30th of June has arrived. The car is still standing in the showroom. And let us see the situation of the buyer of the choice and the seller of the choice. The buyer of the put option and the seller of the put option. All right. Let us say that the price of the car has gone up from $100,000 to $120,000. See, the buyer of the put option was hoping that the price will come down and so he can sell it at $100,000. But the price has gone up. So in such circumstances, do you think the buyer of this choice or the buyer of the put option will sell the car for $100,000 when he or she knows that the market price is $120,000? Certainly not. He or she will prefer to forego the choice or exercise the choice of not selling. And what happens then? In that case, when this person does not exercise the choice or does not sell, then the seller of this option, the seller of the put option, he would retain that non-refundable premium which this person had given him, $2,000. All right. So this $2,000 is the gain of the seller of the put option, and $2,000 is the loss for the buyer of the put option. All right. Now suppose the price of the car has come down from $100,000 to $80,000. Let us say that the price has not gone up, but the price has come down. All right. What will happen in such circumstances? Now, do you think that the buyer of this choice or the buyer of the put option will exercise the choice of selling the car at $100,000? Now, the market price of the car is $80,000, but this person has got the choice of selling it at $100,000 or not selling it. So what do you think this person will do? Certainly this person will run to the seller of the put option and tell him that, look here, you have to buy this car from me now at $100,000 because that is our deal. I want to exercise my choice. And this person, the seller of the choice, will have no other way but to honor the choice of the choice buyer or the option buyer. So he will have to shell out the difference between the cost. That means this 20,000, the put option seller will have to give it to the put option buyer. And since he has already taken 2,000 as the non-refundable premium earlier at the time of entering into the contract or at the time of selling the contract or selling the put option, his net loss is $18,000. And for this person, for the buyer of the choice, his net profit is $18,000 because though he is getting 20,000 now, 2,000 he has already paid earlier as the non-refundable premium. All right. So here again, the buyer of the put option has a limited loss. Had there been a loss, the loss would have been limited to $2,000 the amount of premium which he or she had paid. But if there is a profit, then the possibility of profit is unlimited. And for the seller of the put option, again, if there is a loss, the possibility of the loss could be unlimited. The price of the car could have changed to anything, and that much would have been the loss of this person. But if there is a profit, then the profit is limited to the $2,000 premium which he has taken earlier. So I hope you have understood the concept of trading in options, call option as well as the put option. In the next lesson, we shall quickly summarize this concept and then we shall get on with some technicalities. All right.